Cool. So that link should work in the chat. Just gonna double check it. Perfect. Okay, yeah. So you should be able to see my screen. I'm actually gonna share my screen in Discord as well, because I want this to be more or less an interactive class, more or less. So yeah, basically this is going to be a general class on basically setting up platforms and where you can actually start in regards to trading futures. I know we've covered a lot of the conceptual understanding of trading futures and exactly how to get started once you have a setup and everything like that. But a lot of the new fellows that are in the chat actually haven't had time to go over the process of actually getting a platform and getting everything all set up and everything. So basically, we're just going to be talking about this today, and it's going to be very interactive in the sense that basically setting up here. Yeah, sorry about that. I could just hear myself, but the setup of platforms and exactly how you can chart, like obviously a lot of you are going to be familiar with TradingView, but I'd like to show the new guys exactly where to get started because it's an amazing tool in trading in general. And then I wanted to go over a low risk trading management strategy that we were actually implementing this week that captures a lot of the gains in both directions of the market. So we're going to talk about exactly how we're going to do that this week and how we have been on track to doing that last week. But believe it or not, we're actually going to go in harder and capture even more moves this week. Believe it or not, with a strategy that we're going to go over as well. So for you guys that are just starting and everything like that, what we need to do once you're interested in trading and you're interested in learning futures and you understand like the core concept that yes, we trade futures contracts, and those are leverage derivatives basically that are tools that we use to capture movement in the market on the short term.
Market data connection lost.
And yeah, so basically one thing that we can do is I was going to go over
market data connection reestablished.
Exactly what, like I just basically set up this demo platform on a random platform, and not a lot of you guys use this, but I just wanted to basically show you the rough edges of exactly how a platform would work without any personal information on there and so on. But so the first thing that you're going to notice is that there's a chart. We see a lot of these in trading in general, but basically all of the components of this platform are going to be apparent in every other platform. So you have a basic watch list that basically, if you were to click a stock, it should populate the rest of the platform. And if you were to hover over it, it should give you some information. Obviously, with this being a simulated platform, it's going to be delayed. I've actually never used this platform before, but it's so similar on every single platform that you're going to find the same things across the board generally. So you're going to see things like you're going to see things like watch lists such as that, a chart like this. For instance, for trading futures, they're going to have their own symbols. Like you might have seen ES or / NQ. Like by typing in one of these tickers, like if you're looking to trade the NASDAQ, you would do / NQ or / MNQ. That's a very common one. It's the smaller one. And we can see that's the micro E-mini NASDAQ 100 index, and you can select your month. Basically, futures contracts have different months. You almost always want to click the most current one, and once you are on that, this is the chart for that security. This is all very basic to a lot of you guys, and obviously you can change the time frame of each and every single candlestick. So for instance, now that we've changed it to 1 minute, we can obviously see that every single candle is 1 minute. But if we were to change it to five minutes, 5 minutes, we'll see every single candle is 5 minutes. Now that can help when you're doing different analysis and so on. But and stop me if you have any questions and so on like that.
Yeah, question, John.
Hey, what's up?
So it's pretty much like options trading. So you just need to select the same contract
Yep.
into because we're trading June, correct?
Yeah, exactly. Like for instance, if we were doing /ES, which is the SPY,
Okay.
we would just we would click that, we would go to futures in this case. Usually it would just populate right then and there, and then we would go for either the continuous contract or the June. Usually that one will actually be available in America, but you'll usually see the most current one, and you'll just click that one, and literally all you would do is just buy and sell, one contract. Like for instance, here you would put the quantity. See, they don't even really offer more than 10 at once. Like I'm sure you could change it to whatever you wanted to.
Uh,
Yeah, of course you could change it, uh, but yeah, basically you would just select your quantity and then buy or sell, submit the order, and obviously the market's not open right now, so it's gonna reject it. But the concept is just the same as trading shares. So basically, if I was to sell, sorry, if I was to sell one contract at the high up here and it was to drop and I was to buy it back, I would make the difference essentially. Or if I was
okay.
to buy it low and sell it high, it's as simple as that. And and there's not really any exterior concepts when it comes to futures trading. You pay a small commission, which is relatively cheap. Usually it's under $2. Like I don't know too many people paying more than $2 per transaction. And you can often see the information on each futures contract, like what the tick size will be. In some cases, the the platform will actually tell you, or it'll be on the website. But generally speaking, you'll be able to tell for every point that the index moves, this is how much that contract is going to make. Now the thing is that changes from time to time, and the cost of the contracts can change. Like for instance, when it's really volatile and the markets are tanking, you'll notice that they up the size of the contracts, and for instance, it used to be like $7,000 to buy NQ. Now it's like something like $16,000 just to get one contract. And obviously that's
Market data connection lost.
the full size contract. And they have micros and minis.
Market
Basically,
data connection re-established.
one mini is going to cost more than a micro will, and it'll move more than a micro will. So generally speaking, you'll want to actually practice on a simulated account just like this one first, just to get your feel of how futures trade, and then you can look into getting an account. Like I know a lot of people use Thinkorswim, and Thinkorswim is is a very uh, basic platform as well. Here, let me show you. This is for instance what Thinkorswim will look like. A lot of you guys are familiar with it. Trading, like what's he trading here? See, that's MNQ. For instance, we were just looking into MNQ. This is exactly how it would look on Thinkorswim. So you would have you buy and sell one contract of MNQ, and it would have the level 2 here, so you can see exactly where your orders are going to be and so on. But
And question:
yeah,
Do you we usually hold contracts over, or do we just want to do pre-market only and day trade them?
well, that's the thing. So futures do stay open all throughout the night, but there is a closing period every single day at 5 o'clock, and they only shut down for 1 hour. And if you choose to hold through that hour, all you have to do is pay the commissions on each contract again. So if you have one contract, you'll just pay whatever it costs to get in and whatever it costs to get out of that contract again, and they'll immediately have you in at the open again if you choose to hold it. So generally, it's really, really low cost. Obviously with the time period from 5 to 6, generally there's not a lot of movement anyways. But if for whatever reason Trump is talking at 6, it might be a good idea to get out of your Nasdaq or index futures contracts, because you never know if he's going to cause movement. But generally speaking, you should be all right with it holding overnight. Uh, but generally speaking, people don't trade futures for long periods of times. Like you can, but generally speaking, a lot of people take advantage of short-term price movements with futures. You won't see people holding them for generally months, or definitely not years. I've never seen anybody hold a futures contract for years, but I'm sure it happens. But generally, months is considered long-term for sure, very long-term, in fact. So So that's what I wanted to go over there. And I'm not sure if a lot of you are familiar with TradingView or not, but for instance, let's take a look. This is what we want to get familiarized with, is some sort of charting platform to use when you're trading. And you'll see me live stream this throughout the day as well. And this is basically the charting tool that I actually prefer to use over any brokerage charting platform that I have come across, due to the fact that it's very versatile. Sorry. So for instance, it has many of the like all of the basic tools and many more tools that you can actually take advantage of. And as we went over in last week's class, there's a lot of cool tools that we familiarize ourselves with, like the harmonics and basically how to draw trend lines and everything like that. Um, but if there is anything that you guys wanted to go over in particular on TradingView, I can definitely do that. But one, what's up? Somebody say something? No. Okay, so one major uh, thing I wanted to go over actually today was the play that we actually did on Friday. And this is an interesting play because it it actually shows that if we were to execute this correctly, it could give you exposure to all of the moves that happened on the Friday session if we were to have correctly played it. And basically, the one flaw that we had was actually getting rid of our long position with a stop and profit at the low of day, because we actually captured the high of day with a stop and profit after a few scalp trades of actually trying to find a really good entry. And one thing that we want to do next time is actually maintain a core position long whenever we can, and let the market decide whether or not we should get stopped out of that core position long. So whether or not we have a core position short already shouldn't be the determining factor. If we can develop a core position in whatever direction, we definitely should. And here, I'll show you exactly what I mean. Hey, Jacoby.
And John, for the to pull up the futures on TradingView, is it the same thing /MNQ or /yes?
Well, yes, but the ones that I like to use are actually um these ones here, NAS 100 USD. I find that that one's the best one because it's actually a continuous moving chart, and it is the index itself. So it's not like individual futures contracts can actually have different prices, and they can move differently. For instance, a good example is natural gas. Like natural gas, let me pull up the old
Does that move
platform.
alongside with DGAZ or GAZ?
Yeah, UGAZ and DGAZ.
Yeah,
Yep,
UGAZ.
yep. And the thing
Yeah, they'll
is,
track.
was that there, Jacoby?
I was saying they would track, wouldn't like you gas and stuff like that. They would actually be derivatives of natural gas. Yeah.
Okay.
That's true. So UGAZ is a 3 times bullish ETF that tracks natural gas, but it also has ETF decay, and as well as DGAZ, which tracks it to the downside by 3 times leverage. So if we look at NG though, that one would be the futures contract here. We can see that the June contract is 1.74. We can see the August and August is actually 1.97. Now, you know why it's different is because natural gas is a seasonal commodity and it moves differently throughout the year based on different temperatures. So we use more natural gas to heat in the wintertime and so on like that. So it's higher then. And the thing is um, we can see that in those contracts for the later years or later months. What am I saying? And so not always will it actually be the accurate price of the commodity. Like right now, for one natural gas unit, uh, it's actually 1.889, regardless of what it's going to be in the future. And this is just the price of natural gas, and that's just it. And I find that the analysis on this chart, sorry, is far better than actually looking at the analysis for a predicted uh, chart of a few months from now based on what people's speculations are. Like for all we know, like a couple months from now, it could actually be cold. Like obviously the seasons don't really change much, but you never know, and it could, and then that could throw things off, and there will be a discrepancy in in price, and that might just change up analysis. Like say you're riding a trend line on 1 month, it might be actually different, and if circumstances change, it might have to catch up. And obviously, with just like options, the farther out that you get, the less volume that there is, and the choppier that the charts generally are. So you generally want to have a higher, like you're not going to have liquidity issues, but you might get a wider spread, and that might be unattractive to you on a longer term time frame, which obviously is going to cost you money. If you have a wider spread, that's going to mean that every single time you enter a trade, you're going to have to pay that extra difference just to be able to get your entry, which is unattractive, generally speaking, to everyone. So one other major thing that I wanted to go over was, let's see here. Oh yeah, exactly what we did on Friday, because Friday was really interesting. A lot of the posts that I did put into the chat were only short trades, but we did take like quite a few long trades as well. So just to show you guys really quick, I just want to explain exactly what happened, and this might give you a better idea of how to follow along in the chat and so on. So in the pre-market, we were looking for a spike up in the open, because we had a nice rally overnight, which brought us to a relative high for the open, and we could see that we were forming a bearish pattern, this rising wedge pattern. It's not a very inclined rising wedge, but we could see we clearly had two highs and two lows on our momentum. So our momentum was definitely losing, as we had, a clear increase where the highs were making higher highs, and we were clearly getting higher lows as well. So that's very important. So with that being said, we got our spike immediately at the open, and when that hit our parameters, we could tell that that was actually an exhaustion spike out of our bearish pattern. So with it being so high on such bad momentum, we knew that that was very likely to come down. So I was like, consider a short on the Russell, bearish on all of the major indexes, and hold a core position short. So don't sell it quickly, is what that means. Like hold on to it until you get stopped out, ride it all the way down to low of day, is what we were actually saying. And we were I was laughing about it when I was saying that, but I was like, I'm serious actually. And sorry, and basically we put our stops in profit almost immediately, 2 minutes into the trade. So we took our entry on all of the major indexes, for that matter. I shorted every single one of them, and they all started to come off, and immediately we put our stops in profit. And I took some off originally, and as soon as it started to drop, the rest of the major indexes are honestly started dropping a lot more at the time. You can see they didn't have as much of a spike, but they actually gave us enough of a spike to get an entry. So we can see that the Russell continued to come off of its spike too. It had more of a predominant spike, so that's why we really went for that one first. Now, with this chart, we actually we're taking profit in this chart. We were expecting a bounce, perhaps back up to the previous consolidation level. As we can see, we actually did have a little bear flag here. We were watching for that bear flag corrective wave a few moments prior to that drop off, and now we were expecting a bounce there. So if we go back down, we're still holding a stop in profit on that at that point. But if you were to see from that 9:55, or sorry, it would have been 10 minutes prior to that, we were actually expecting that bounce on the other major indexes. Now this is the Nasdaq, so it actually uh, looked a little bit different from the Russell that we saw there. But what's up? Okay, sorry. So as we can see, it did spike up. We took profit on the way down. Obviously, our stop in profit for the Russell and all the major indexes were hit, but we were looking immediately at shorting the Nasdaq up here on this next overextension for a 50% retracement actually on this pattern. This pattern is one that actually gives a nice 50% retracement, generally speaking. and we actually added to it on this chart here. So at the very top there, we were looking to add to it, and immediately it starts dropping off. So the first shares that we shorted right here, we were actually dumping them for a profit and holding the ones that we had at the top there, and putting a stop in profit. So once we've seen that it's dropped off and then it comes back up and establishes resistance, we drag our stop down to that high of that resistance, and then watch it continue down. So as you can see, we actually got that 50% retracement of this large move down. So we're taking a little bit more profit by that point. And if we can see, the Russell that we were expecting a bounce at that point from earlier, you remember we had our bear flag and then a drop off. So we definitely got our bounce. And at this point right here, we were actually shorting the NASDAQ. That was the last picture we had. So we were done with the Russell at that point. But if you still actually had your stop and profit, you wouldn't have been hit. So at this point, you're still riding it down. And I was like, took more profit on the Russell. And that was it for that one. Um, and then obviously when the markets are forming a symmetrical triangle like this provides higher risk trades. We really don't want to be trading things that are in the middle of another range or inside of another move. Like you can see right now, the current price is inside of this move and inside of that move. And we want to refrain from that. We want to try and trade it when it's at its lows, when it's at its highs, when it has high probabilities of reverting back to the mean. And but yeah, so I'm just making this all very clear for people that are having trouble following along in the chat and so on like that. But basically, as you can see here, this is one of our classic bearish harmonic patterns. Forming the D leg. We were obviously looking for this little bit more out of it. Uh, you know, if you were watching for a short entry and you started scaling in, you would have easily been able to get your stop and profit on that trade. And then it pops back up, and we are looking immediately to short it again. And as soon as it pops up to our yellow level, we started shorting it, and and it actually popped up even more in that case. And I was like, I'm shorting the crap out of it at this level. I'm like, okay, it's definitely coming down here, and as soon as it does, we short the crap out of it, and it falls down to our average price again. So we were able to take our original position off and on hold, those that large size of contracts from the highs there, and we're expecting our corrective wave here. When we say corrective wave, that's usually a bear flag, an ABC pattern, which are we go over in many of our different classes. And as you can see here, we have that bear flag. We played that bear flag out to our support line that we were looking at before. It was a red support line. We had it very clearly identified there. And as it came down, you can see we actually had a really good exit on that trade, and it popped right back up again. We're looking for another short at the red line, and as you can see, it gets up to the red line here, and immediately starts coming off from the red line, and we're able to get our stops and profit yet again, playing another move with precision on the Nasdaq, and it falls down. We took a little bit of profit here, and we get stopped out with a profit on that one. So we're looking for another trade here, and then let's see where that one goes. It comes off, makes another corrective wave. So remember how we had that corrective wave here? It's exactly the same pattern. We have an A, B, C, D pattern that came all the way down to our 161. And this is a serious profit taking point generally, but we can see that it actually wanted to come down and retest our red line again. So shortly after the retest of our red line, we can see that it actually popped right back up, and we were looking for another short on this bearish harmonic pattern. Another bearish harmonic pattern gave us the ability to put our stops in profit, and as soon as that trend broke, what did we have? Another corrective wave. So this is another one of those bear flags that we look at quite frequently. And even though that it came back down and it formed another rising wedge here, we can see that we had another rising wedge pattern that gave us another ability to put our stop and profit there, and ride that one all the way down, And this is, you know, this is my favorite pattern, to be honest. This rising wedge pattern right here, where you've got the two lines intersecting and converging together at the highs, and then it results in a low volatility area where it tanks down. And if anybody's watching, you can actually see the bearish harmonic pattern that was formed there, and another version of this pattern here, which played out immensely all the way to the low of the pattern. So that's really cool. Oh, see, look at how well that played out. All the way down past the 61%, hit the 51. That's really cool. So, oh, look, it had a little bit of a bounce off of the 38, and then back up to the 23 and down to our red line. Remember, this is the red line we were looking at from before, so that's really interesting. And it got even more demolished. So at this point, we're still short from our entry here because we haven't been stopped out with a profit yet. So until we get stopped out with a profit, we're maintaining that core position short. Now, this is the main strategy I wanted to tell you guys about. I wanted you guys to be familiar with this. So we're holding a core position short from up here, from the tip of this rising wedge, and we've taken profit on the way down and managed it accordingly and so on. But nonetheless, we've held our highest entry with a stop in at break even for all I care. It's just in a minor profit. And at this point, we're like, consider hedging with a long. So what you're going to do is you actually keep that NASDAQ short. And what you do is you switch over to like either another month or another security like the Russell 2000. You actually go long. So you maintain your core position short and you go long here at the same time to keep your entry. And what you can do is you take that trade up, and we can see that you know, we hedged our existing short position with an opportunity to take like a nice hedge and buy like 3 SPY or NQ contracts to outweigh the fact that we're going to be wasting our time if we don't do something about this short position we have. So we maintain that short because that could be the 52-week high for all we know. So why would we want to get rid of that? Until the market dictates that that's not going to be the high anymore. Because if you can get multiple days out of that one contract and 1,000 points, you know, without having to manage it, and literally just hedging it to the upside whenever you think that it's actually going to go up against you, and it's good. And there we have it for that day. The 4 o'clock hit, and we didn't really trade anymore. But I just wanted to go over that day with you because I thought it was quite phenomenal. And if we take a look at the um, uh, chart here, we have the analysis of exactly what went on there, which is quite interesting. Like we had many great days this week. Like we caught this very high here, you know, um, very many good trades throughout the week this week. But I just wanted to go over that with you and make sure that you guys understood that. I didn't want to keep you for too long, but if you did have some questions or anything about how to read the chat or how to go over any of these analytical methods or anything like that, I'd be happy to go over anything with you. And
You want
yeah,
to touch on scaling in and averaging down, John?
sure. So scaling in and averaging down. So this is a great way to look at it. Obviously, that chart was a little clustered there, and that's fine because you can actually do things to remove it so that you can you know, see things more visually. Like for instance, clicking the hide button on TradingView is very useful for when you're doing things like I'm about to show you, which is gauging the mean. Like for instance, one major indicator I've mentioned this one a long time, for a long time, is this moving average ribbon. You can get it on any platform, and it's very useful because it can give you a good idea of the volatility, the trend, the distance from the mean, and that's about it. And perfect. So we can also see, um, no, for instance, hold on, I gotta look at something that allows me to use volume profile. So we can see that volume profile and MMAR should be working here. Okay, perfect. So what I like to do is I actually like to gauge the distance from the mean. So for instance, in this case, we want to make sure that we're at a high point of volatility. So for instance, when we can see that the stock is moving at an extreme level and it's at an extreme low or an extreme high. So we can tell by how far the bands are from each other. And for instance, you can see at this very low here that the bands actually are very far from each other and they're at a larger distance than when, for instance, the chart is moving rather sideways, and you can see that they actually like to cluster up in those times, and at the times at which this indicator deems that they're far away, you can see we get almost like a failure in the way that the lines can move together, and the distance is a lot higher at that time. So generally speaking, those are higher probability times that I would be looking for divergences in momentum and for uh, reaction to some sort of long-term resistance. So one major way that I like to
What's the time frame on this?
so this is just the 1 minute. So generally speaking, I like to see an overextension on all time frames. So I like to see it as a at a very high point relative to its usual trend or a very low point relative to its usual trend with enough volatility to actually revert back to the mean. So um, generally speaking, the indexes are really good for reverting back to the mean. Like low float penny stocks and stuff like that generally can stay low for long periods of time and not actually revert back up the way that you would think that they would. Um, but but generally stocks that are in the Dow or like blue chip stocks have really good reversion to the mean potential. So one major thing that I can see is if I look at a daily time frame, for instance, on something like let's look at like CGC because they're moving recently. And if, for instance, I can see that they're coming from an extreme low on on an increase of momentum, I would see that opportunities to go long at its lows would be uh, ideal. Like we actually did take it long when it did come down here in the last room that we were in, but nonetheless, this time we didn't. And the reason for taking it long off of these levels is because we can identify the trend, and that's by connecting the highs of the chart, as you know, and basically gauging the distance from the mean. So once we've determined that it has a far distance from the mean and it's tanking below all of these levels and all of these moving averages, we can start to look for basically a divergence in momentum. So when the momentum starts to increase and starts to show that we are at risk of breaking the downtrend, then we can take action on the new trend, which in this case was sideways for a little bit, but then it went up. And we can see that it due to the fact that it had that gaining strong momentum and then an exhaustion spike to the downside, it spiked right back up to that momentum, consolidated on a little bit, and that's normal because usually that's how spring bottoms are formed. And as a result of that spring bottom like pattern, a new trend was able to form, and we could see it come back up. Another one that we did that with was space, and I really enjoyed this trade as well. It was a very lucrative trade, and we bought it actually under $10, and managed to have a price target of 17, which we got on that first run. And that $17 price target was hit, and then eventually it actually hit $20, and then even higher, 21, and so on. So that same building of momentum and building of a divergence at such a low price was something that we were interested in. Another one that we took as well was I think it was, what was it? No. What was that? What was that real estate stock? LADR. Now this is one that we don't usually trade, but it just goes to show you that a stock like this, we actually had the ability to catch a 100% trade on this overnight. So we had the same kind of bearish trend going on there with the increase in momentum. And as a result of that increase in momentum, we actually caught that one huge candlestick and managed to sell it at the high of day. Chapman, one of our analysts, caught the full trade and was very happy about that, obviously. And another one we did was BBBY, and this was another major one. We bought at the low of the triangle there. These are all in overnights too, and you can see that the price target was $6. It came a little bit up above $6. Jacoby, I believe you took this one. I made some money on that one as well, and that had a nice build of momentum. As we can see, the price is making lower lows, and then the momentum is clearly making higher highs. And we had some buy signals on the RSI as well. So that was another one. You know, Also, like, even with the whole market in general, when we first initially started like this room, one of the first things that we did was we were going long in everything. Like, if you can see, like, all of these gains are from us buying at the lows. Like, literally, Bank of America catching things like 16% gains in McDonald's and stuff, like buying FAS, the Direction Daily Financial 3 times leveraged ETF. Like, you don't see me do things like this unless it's very bullish. Now you can see these are the setups that we were actually going for. So we can see like a clear increase in momentum with an exhaustion spike to the downside through a major level. This is 52-week lows. Like, people aren't going to get these prices again. Like, look at the kind of overextensions we're shorting on Zoom. Things like that. You know, uh, Even going long in things like Apple on the 61% retracement after taking it down from the highs. Like, we were all bearish at the top of the market, like very, very top. We were shorting the crap out of it. And one of the first things that we did when we opened this chat was long Wells Fargo on a falling knife. Literally, nobody's going to touch this. We were going long Bank of America. And then the next day, we're seeing bank like 17% gains, 13% gains. So it's like, now that you see that the market's up, don't be saying that we're only shorting all the time, because we're not. It's like the market is giving us opportunities to short the crap out of it and get exposure to a potentially huge drop, like we saw at the high of that list there. But anyways, I just wanted to go over all those things with you basically and briefly. If you do have any questions, please let me know. I'd be happy to help you out with that. And yeah, we'll continue going with it. But the main takeaway is I want to be able to get you guys to manage into a high probability short entry, manage to keep your core position shorts at the high by only moving your stop and profit down as it creates new resistance levels, and then as it drops, instead of selling your long position, you can actually hedge it for more exposure to the downside ultimately, but not actually having to sell it. You can actually hedge it by going long in another security and maintaining that uh, core position short and until it's obvious that it generally wants to come up. And I think that this is the strategy that we can impose in order to capture the next large move to the downside from the market, or at least maintain exposure to it. So this is a relatively low risk way to maintain short exposure while still capturing every long trade that we can possibly see, but as a hedge against our short trades. So I really wanted to make that clear, that we're going to be going through all of the different moves in the market. As you can see, we can actually take 80% of the moves of the market successfully, as we did this week, and we're going to continue on that track.
Do you have a video up that navigates Thinkorswim and how to set that up currently?
I'm actually in Canada, so I don't use Thinkorswim. So we actually need to get one for Thinkorswim in particular. But we could hook you up with a guy that would actually help you if you wanted to go to set it up in particular, because that's pretty much what we're doing now. Until we get that video going, but we will. I don't personally use Thinkorswim, so that's why it's kind of like a little iffy. Or I would have just shown you on there, but we actually have to.
I want to have one platform to where I trade the futures only.
Yeah, exactly. So you can do Thinkorswim. Now, one thing I like, the reason why we wanted to talk about platforms this class is actually because Thinkorswim has been failing a lot of people lately. And it's like, for instance, you put in an order, it doesn't get filled, and then all of a sudden you're in the other direction. And it's like things like that. You don't want that when you're trading futures, especially large size. And there's been a lot of that lately. So guys have been TradeStation, which is actually one of the most common ones, which I have heard no bad things about yet. So, from what I can see, TradeStation gets all of the boxes ticked in the fact that they're cheap. They're cheaper than Thinkorswim. They may not have as many bells and whistles, but the thing is you can do everything that you need to do on there, and it's very basic. You're not going to get really confused. It might take a day to learn everything. Like, you're going to look at it and you're going to be like, okay, what is this? But once you figure it out, it's very, very simple. And once that's out the way, I feel like you'll do really well there. But Thinkorswim has been having issues, so I don't know if you would want to get all set up on there just to find out that you might not get um, good entries and so on. And you're gonna have to pay more on top of that
I
too
mean,
for that.
are the future contracts just like options? Like you have a limit buy, and you also can set a market price.
Yeah, exactly. So the order
So
entry is going to be the same. Yeah.
is there a reason why you wouldn't want to do a market price right just to get it filled right then and there?
No, not necessarily. With futures contracts, you have high liquidity and tight spreads. So usually you can get away with doing a market buy. Like a lot of my trades, I literally just click the bid or the ask, and I actually just populate my limit and then click enter immediately, and it'll fill me at whatever price I have at the bid or the ask there, generally because it's so high liquidity. But in times where the markets are moving really hard, you might not want to use a limit order because you might not get that precision entry that you want. But if you just click the bid or click the ask and you're buying or selling, generally speaking, you should be able to get filled, especially if you're clicking the most favorable one to the broker instead. Like if you hit the opposite side of the bid or the ask, and you should get filled almost instantly. But you shouldn't have to worry about actually using the market buys and sells, generally speaking. But if you can, you want to use limit orders always.
So, John, if you want to, I don't know if you did, but maybe explain, like, let's say the Nasdaq is in a rising wedge, and
Okay.
you alert chat, like we're watching this for short. Um, Explain maybe the process of what happens if someone gets a contract at 9200, but it moves against them and jumps to 9220.
Right, right. So that's exactly what did happen in the chat on Friday, and
Right.
there's interesting situations like that will give us the opportunity to add to our positions. Like, for instance, if it's running up on let's see, was this the actual moment? No, 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 this was the moment. And let's see here. So, for instance, we can see that it's running up very hard, and it hit our resistance. It already broke one major purple line resistance there, and then it came up and it smacked our yellow line. We actually shorted it. I believe we shorted it
Yep. Right
there.
there.
And
Hmm.
then and then it ran up a little bit more, and then I was like, let's short the crap out of it. So that means literally double your position, triple your position, and then off of this high resistance, because we could see there was a clear loss of momentum between the two different highs that we had here. We could see our MACD leader was actually coming down, our histogram was coming down, and the lines were converging at the highs. The trend was weakening overall, and this put the overall uptrend in jeopardy. So once that overall uptrend breaks, we expect that new trend and a retracement into that trend. So in this case, it actually retraced all the way down to the 76.8% retracement there. And as a result, we managed to capture the majority of that large trade by keeping our stop in profit and actually riding it all the way down there and taking profit along the way. So yeah, like opportunities like this, for instance, where whoops, where, for instance, you are riding the downtrend and you can see that it almost spikes back up. You might have bought in here on this doji, and then it spikes down even further, gives you an opportunity to load up on potential. Well, let me see here. Does it have support? I guess. Let's see. Let's say it may have used these two highs here. So let's say that that is support, and then it spikes down to even further support. It actually could have been um, a Fibonacci level there too. Yeah, we can see that that Fibonacci level actually correlates with this 41 here, and with precision, that orange line held, and basically we got a huge rally off of it. But we can also see that through this time we had a slight build in momentum. You can see that the indication on the RSI was starting to go green, and generally speaking, that's pretty good about it as well. You know, you can even see that it tried to short it at that point too, and then decided to add at the very, very top there as well. So yeah, very interesting. Um, but yeah, no, is there anything else that you wanted to cover today?
Yeah, John, you know when you're trading futures, I'm not trading futures but at the moment, but trading futures, how do you know how much gain when you trade in a micro, for example? How much do you know, how do you know how much profit you're going to get on one tick, you know, on a
So
micro, any,
on
like,
on Thinkorswim, you actually have if you want to snip it, Jacoby, for me, that would be great. But like, there's like a way that you can actually see on each individual contract what the tick size is, and that tick size does change depending on how much the like what the current market environments are. But
So actually, if you're in TOS, Divas, and you click that down arrow box where you would enter your ticker,
yeah.
and there's like a futures tab right there. And if you scroll through all those futures, you can see the tick size and the tick value for all the futures.
Okay, I'll take a look.
So that's the price of each contract, correct?
So that'll be the margin requirement, yep, and that'll be the tick size and the tick value as well.
so the margin requirement is how much it costs you out of your account, and then the tick size is how much per one of these like small ticks on like 0.5, 0.0 is gonna actually translate to a dollar amount for your position, as opposed to point size as well. So each point will be worth a different amount.
So that's the price of each contract, correct?
The price of each contract is the margin requirement, or initial margin.
And that's just what's held basically.
Yep.
When you're trading it.
And the tick sizes, it refers to the movement. So for every dollar that the index moves, it's going to be like, it could be like $10 for your contract. So it's like the delta almost, tick size. So like for every dollar that the index moves, that the Nasdaq moves, then your contract's gonna move like $10, or it could be $5, could be $15 for every point that the index moves, and that's the tick size.
So you got to be like careful when if you were trading a future and you call one out and you were saying, okay, we'll go short here. If you're in micros, you got to kind of be careful that you don't, you know, you're maybe playing a big contract, so you know that you just need like one tick and then you're good, you're out.
Great
Because
point.
if you're playing micro,
Yep.
then your
Scalping,
commissions,
yeah.
your commissions are going to be more than your,
Yep.
you know. So it's just a case of knowing when you're going short and long.
Yes.
On
So like,
on a big contract.
You want to take those big reversal moves on the micros, because that's what I do. I focus on those with the micros. You know, there's those scalping moves that John does plenty of. They're great, but they're very difficult to capture with those micro contracts.
Yeah, like for instance, a move like this on this 2-candle move here might translate to $300 to $400 on one contract of NQ, but only $13 on a contract of MNQ. That's the vast difference. Like, to make it all the way down here, you're probably looking at around $300 tops on a small
They're
size
tenth
contract,
of the size,
and you're looking at probably around $3,000 on one contract of NQ to hold it down.
Right.
Mm-hmm. So
and is that in one day, one pre-market?
Oh yeah, this is in 14 minutes, brother.
Oh yeah, I'm done. I'm out of here. I'm never trading options again.
Like I'm looking at 2 minutes there for potentially, you know, around $300, or maybe on a small size contract you're looking at maybe $15, but on a move like this you're looking anywhere from like $200 to $300 on a small size contract, which is going to run you just over $1,000 to get into that position. The contract size, the initial margin is going to be like it's going to cost you around like, what is it, like $1,200 or something?
For M&Q, it's 1650.
Okay, 1650 they raised it, and it's not gonna be worth as much. So for like $16,000 though, you can buy NQ, and a move like this is gonna be $300. A move like this is gonna be 3,000 in 15 minutes. So
Or for instance, a 400
yeah.
point move that was captured on the Dow would
Oh
be
yeah, dude,
ridiculous.
we like literally I posted this short trade here from this very top C point down 455 points. Oh, that's the Russell. Sorry, my bad. It was the Dow here. 454 points on that trade. I was too tired to stay awake by that point though. I had to go bed. But the that move was relatively huge,
And that was in just 12 hours. That was all. That was from the morning, and then you stayed on
yeah.
all, like, basically into the night, and we caught that other drop as well.
I'm still in that trade too, so.
Of course you are.
Yep, I got out of a bunch of it here. I've only got one left though, but that's all good. Anyways, at the same point we were also shorting the other major indexes as well, but we can see that they had different recoveries, and the Nasdaq.
So when adding to your position, John, for those that don't know, like when you see it moving against you, what are the levels that you recommend adding at if it's moving against you?
So
you don't want to add every 2 points, right? Because you don't want your average. You want your average to change dramatically.
Yeah, exactly. So the idea is when you are adding to your position, it's not so that you can affect your profit and loss in any way, shape, or form. In fact, there's nothing that you can actually do, or there's nothing that I'm going to tell you to do for the sake of your profit and loss. It's all for the sake of managing the position into a profit, and for managing your position off of the associated technical levels and so on. So for instance, to add to your position at the same level only increases your exposure but does not reduce your risk. It actually increases your risk. When you add to your positioning, it increases exposure, and it increases the magnitude at which your position moves, because you have more of it, obviously. And so the one idea in order to add to your position, in order to find that pristine moment, pristine trade where you are willing to add to that position, is going to be one where it's building up a reversal pattern. It's at an overextended level, and it's building momentum in the opposite direction, preferably overextended in the favorable direction on a longer time frame as well. So if it's high on the daily, you're looking for a short trade, which is also high on the intraday chart, which is also part of a bearish pattern, meeting resistance and having a bearish divergence, and momentum is falling off of the price, making higher highs, such as this one. And preferably, if you do have a bearish pattern at a high like this, let's say for instance if you're looking at a rising wedge and you've been watching these highs for so long, and for instance it pops up, everyone's getting stopped out, and that's perfect because it offers you the opportunity to actually get an amazing position at an overextended level when we know that it's extremely high on the daily chart as well. And that's why it offered us a great opportunity to capture that downside that we saw over the past couple days. Um, yeah, yeah, so that's good. And yeah, like the same thing goes for pretty much every other security too. All the analysis, like gold and so on. We've been trading a lot of gold lately, and as you can see, quite a few Elliott waves that we've taken advantage of here. We can see we've got our 5 wave impulse with our corrective wave there. Another Elliott wave happened here, and a corrective wave and so on, and another one to end it over here. A little bit of a we that was actually the prediction for it, and I'm looking at it, and it actually did work out very similarly to what we thought. It was just a little bit more overextended, but that's fine. But yeah, no, I hope you enjoyed the class. If you do have any questions, I'd be happy to answer them. But yeah, we'll smash it out on Tuesday.
Thanks, John.
Yeah.
Yeah, thanks, brother.
Yeah, anytime. I'll talk to you guys soon.
Thanks, John.
Yeah, take it easy.